Pratik Gupta, who's joining us on the show to give us a sense of his outlook on the markets as well as valuations and the earnings season. Pratik, thank you so much for taking time out and joining in. Let's just get an overall sense as to what you're looking at when it comes to the market landscape at the current juncture. Do you believe that as of now, the undertone of the market is remaining quite positive, but global headwinds, the overall valuation, as well as concerns of the macros, is putting a bit of a concern on the markets in terms of the undertone being a little bit cautious?
Hi, good morning. Yes, we are still not bullish on the market as yet, but honestly, we're also not as negative as we were, let's say, at the start of the year, because we've been through a fairly substantially long period of time correction. India has been largely flat for almost a year or so. And over the last 6-9 months, we've also underperformed markets like Hong Kong, China, which had underperformed earlier. So global flows are also slightly more positive on India, given the time correction and valuations. And meanwhile, the earnings growth in India, for the corporate earnings growth, they've actually held up reasonably well despite the ongoing consumer slowdown, despite the global issues, etc. So you're absolutely right. We see two major issues on the downside. One is the global slowdown and the uncertainty around, therefore, how the Fed would react, both on the inflation front as well as financial stability, given the recent regional banking crisis. And second is just domestic factors like monsoons. For now, the fear has sort of subsided given the IMD's forecast, but we won't really know until May, June. And also we need to watch out for the distribution and the timing of the monsoon as well. So it's not just the quantity. And that obviously still has an important bearing on certain sectors. But overall, the medium-term outlook on India remains very, very positive. We are one of the few countries, EMs in the world, where political stability is there, and the corporate sector has deleveraged. Banks have cleaned up their act. They're well capitalized. So to that extent, we are quite well positioned for an upcycle, but just not as yet is our view. Therefore, this year, we think earnings will still be somewhat subdued. At Kotak, we in our estimate, FY23 will end the year roughly at about 11% earnings growth for the Nifty. And in FY24, we will end up at 13.5%, 14% for the Nifty. And FY25, we will see a little bit of a pickup going up to almost 16%. So that's slightly below consensus, but our concerns are around the ongoing consumer slowdown, the global slowdown, some of the export-oriented sectors. You could see further cuts. We saw that with IT, for example. So those sort of concerns. And India is, like you mentioned, valuations are still on the higher end. We're still at 19 times FY24 earnings as far as the Nifty is concerned, 17 times FY25. So it's become more reasonable compared to 3-6 months back, but we're still not cheap enough.
Sure. Pratik, can't help but talk about IT, considering we were just chatting with the TCS management, and while they still see a probability of a double-digit growth in FY24, they're only at best confident about UK. Say US is still pretty much nimble, and there are increased risk aversion and caution in the spend segment in the near term. Can IT really pull a rabbit out of the hat, and can it do the trick after, stark underperformance of late?
I think the most important thing to keep in mind is that this time around, the IT downturn, even if the US slows down quite sharply, which is not our base case, especially given what the markets are pricing in globally, we don't think the Indian IT companies this time around will be as badly impacted as we saw in, let's say, the 2008 crisis, or even going back 25 years to the 2000 post Y2K bubble bursting and the US tech spending slowdown, etc. While there is clearly the issues of the regional banking crisis, and there is a slowdown in some discretionary spending, decision making is taking longer, deals are taking longer to close, pricing, there's very little pricing power, if at all. But the benefits are also that attrition rates, wage hikes are coming off. And I think more importantly, this time our companies in India, they've gotten the scale. They have really beefed up their capabilities, the breadth of services they offer. And also don't forget, there's a cost takeout initiative going on right now in many of the US companies. So that's where, again, our Indian IT companies are relatively well positioned to help their US customers take out costs, as well as the ongoing stuff like cloud migration and apps for the cloud, and later on we'll soon have AI and machine learning also picking up the whole digital theme. So our companies are quite well positioned. So there will potentially be some more downside if the US downturn gets worse, but that's not a base case for the time being.
Okay, so that's not the base case for the time being as far as how the outlook for the IT sector and demand environment in across the globe is concerned as well. But then, Pratik, where is it that you are seeing value when it comes to the various sectors? How is it poised? Is it the likes of autos, etc., which is likely to do well? Are you expecting a bounce back in consumption? Where do you see value the most?
So the only sector where we still see some value is still the financials. I know it's a consensus view now, I think, across the board, and the sector is reasonably heavily owned. But nonetheless, that's the only sector where valuations, even on a pre-COVID basis, are still somewhat reasonable compared to the rest of the market. They're still somewhat reasonable compared to the growth and ROE prospects. They're still somewhat reasonable. And given the likely pause in rate hikes, we think the RBI will stay on a longish pause. Globally, the markets are pricing in that the Fed will hike only 25 bips next month. And after that, again, there could be even rate cuts going forward. So banks, we think, are still looking quite good. Loan growth may slow down slightly, but hopefully not too much is our view, given we're not assuming a bad monsoon. We're not assuming a very sharp global slowdown. And also credit costs will likely continue to come off a little bit. Margins may come off slightly, but not too much, the NIMs. And therefore, banks still look good in the overall context. Even the NBFCs, given that perhaps the worst of the interest rate hike cycle is over. So we like the private banks, even PSU banks, some of them, the larger ones, the NBFCs, more the auto-focused NBFCs rather than the consumer-focused NBFCs. Consumer sector generally either still expensive or we see more risk of earnings downgrades given the ongoing consumer slowdown, and there's no sign of any imminent recovery. This slowdown can carry on for a few more months or a few more quarters. Very tough to figure out when the recovery will happen. No signs of it as yet. So therefore, really banks and the financials. Second category, I would say, is some of the smaller sectors. There are pockets of value in real estate, for example, more residential real estate. Then there is hospitals, telecom in a few cases, and so on. So by and large, the market, like I said, is still not cheap enough. It's getting cheaper. It's become more reasonable. But are we cheap? No, not yet.
Interesting that you talked about real estate, Pratik, considering, the Q4 updates from most of these companies and, pan-India presence players has been very, very strong. But what I want to understand is that given that, when it comes to real estate, the problem is always the debt that they hold on their balance sheets. Would you stick with the larger players, the more cleaner balance sheets, or would you say have an across-the-board sector exposure because that's going to give you better returns?
No, I think you hit the nail on the head. That has historically been the problem with the real estate companies, the high debt some of these companies used to carry in the past, especially even the larger ones. But there's been a dramatic change in the last 5-7 years where most of these companies have significantly deleveraged and they're generating good free cash flow in some cases. So I would say rather than the size of the company, large versus small, one has to look individual company-wise and look at companies where the debt levels are now under control, because there is, like I said, there is still the risk that we may see a bit of a slowdown both domestically and globally, which may be worse than expected, in which case you don't want to be stuck with a real estate company, which is a very high leverage and could really face a pretty bad time. So therefore, still stick with the companies where the balance sheet outlook is balance sheet quality is very good, and there are honestly both large caps as well as some small mid caps which are niche city centric players like in Bangalore, etc., which are quite decent and where the sales growth is still going on quite well, and at least over there in real estate we've not seen any meaningful signs of any kind of slowdown even in the month of April so far.
Pratik, it was quite interesting that we've seen the likes of an L&T quoting at its 52-week high, the fact that order momentum has been intact, and that really, spells a lot in terms of what the underlying economic strength as well is. Do you believe that there's a lot of potential to really build on this theme, the likes of defense, railway, capital goods as a sector?
I think depends on your time horizon. If you have more than a 1 year time frame, a 2, 3, 4, 5 year time frame, yes, absolutely. These are, in our view, very strong structural growth stories. The private capex cycle in India has been depressed for a very long time. We are seeing the government, both the central government, state government, as well as even PSUs stepping up and keeping up the capex momentum on their side. And we obviously have the elections coming up next year. So generally, we tend to see pre-election spending by various state governments and even the national government. So the outlook is very strong. And also, as I said, the private capex cycle, while it's been delayed and we keep waiting, but it's with every passing quarter, we're getting closer and closer to when it sort of takes off. So that's where these companies, while in the short term, meaning the next few quarters, there is still the risk of a modest disappointment in earnings or order inflows or perhaps margins. But structurally, these are very, very high quality opportunities to play the India domestic growth story. And the only caveat I would put is companies, the cap good companies, which have a very large proportion of dependence or revenues coming from exports, either to Europe or to the US, either to the parents or parent organizations or other customers globally. That's where we are seeing, given our sort of cautious view on what's going on globally, the preference would be for those companies which are somewhat more domestic oriented. And L&T obviously is one of them, although they have the Middle East exposure, but that again, with oil staying quite high, that helps them as well. But structurally, we are very positive. It's just short term, we would be sort of more neutralish. We don't expect a very big correction as well, given although there is a very high, most of these stocks are no longer cheap. But at the same time, given the structural growth prospects in our conversations with many investors who have a long-term view, everybody is waiting for a correction to buy these stocks.
Pratik, what's the house view on how to approach pharma?
So pharma, we are sort of neutralish. It's very, very stock specific. I think one general comment we'd make is in the pharma sector, it's very, very company specific. You've got the APIs, the generics, the domestic kind of companies, the more export oriented companies, and then large caps, mid caps, small caps, etc. We've seen a series of generally disappointments across the board, either governance issues or some US FDA issues, or delays in ramp up of certain products or getting approvals and so on. So the general pharma space, we would be somewhat cautious. There are a few niche companies, or not niche, specialty pharma companies where we would be more positive. But our general preference would be, but let me just say, sorry, we are not negative on pharma. We just sort of neutralish, very stock specific bottom up views. However, our general preference would be to go for healthcare, and within healthcare, more hospitals, not diagnostics. Diagnostics, we still think competitive intensity is still very, very high. There could be risks of further revenue and margin disappointments. But hospitals in general, we think the outlook is very strong. The stocks have corrected quite a bit. Valuations are getting more reasonable, and these companies are generating reasonably strong growth, and the ROEs are quite good. And there are both large caps as well as certain mid cap hospital companies, regional players, or special niche focused hospital companies which are on, let's say, children's care or something. Those kind of companies, they still look very good to us.
Thank you so much for taking time out and joining in, giving us a take as to what your outlook is on the market.